Am I behind? This is a question we all ask ourselves at some point in our lives. In today's video, we'll break down a few reasons why you may be behind in your retirement journey and what you can do to improve your situation. I am a certified financial planner and the founder of a wealth management firm, and I have helped hundreds of clients ensure they retire at the right time by using a combination of different financial planning strategies. The truth is, there is no right time to retire. Most people have the potential to retire sooner than they think, but quite often, they hinder their own retirement because they fall for the common pitfalls that trap pre-retirees. In today's video, we will be breaking down the more common reason pre-retirees fall behind, and we'll also walk through some tips to fix them. The first reason you're falling behind is you're letting near-term market conditions affect how you think about your money over the long term. As a behavioral financial advisor, I see this all the time. You've said things like, markets feel way too high right now, and this election is really going to affect my portfolio. Or the war over there in the other part of the world is going to crash our economy here. And yes, I have heard all of those things, a few of them this week alone. Let me rattle off a few more since the great financial crisis, and you can think to yourself if you've worried about these as well. S&P downgrades US debt, US government shutdown, Ebola virus, Brexit, trade war with China, COVID, Russia invades Ukraine, etc., etc., etc. The list will go on. The problem is that all these tend to be short-term issues, and you are allowing your short-term emotions guide your long-term planning. What I typically see is that people will try and arrange their portfolio for these short-term events, not realizing they still need this money to grow well past these events. They are effectively trying to time the market based on their emotional feelings. Here are two common strategies used by those who successfully retire early. The first is, remember, if you're a pre-retiree still working, you still have cash flow from your job, and you aren't reliant on your portfolio yet. If you are over 5 years away from retirement, you might be able to handle a little bit more risk than you think. You still need to ensure your portfolio aligns with your risk tolerance, but this might give you some much needed growth of your portfolio. Second, if you're about to retire or already retired, make sure you have 3 to 4 years worth of expenses in bonds or safe investments. This prevents you from having to sell equities during market volatility to cover living expenses. This strategy, known as building a bond ladder, helps you manage your funds during market downturns. Market corrections and bear markets typically last around 3 years, so this buffer provides a secure source of funding during such times. This also allows you to be confident that you can hold on to your equity a little bit longer. I have a separate video about creating a bond ladder, specifically if you want to take a look, in the description. So this leads into the second reason why people are retiring before you, which ties into our first example: poor portfolio management, particularly as a result of risk aversion. While everyone else has been averaging 10% returns in equities over the last 20 years, you've been getting 2% in cash and bonds. Many people think they're being prudent by avoiding risk, but in reality, excessive caution can be just as damaging as recklessness. While you might believe you're protecting your nest egg, you could be missing out on substantial growth opportunities, leading to slow or stagnant growth in your portfolio, which inevitably pushes back your retirement. Risk in investing isn't just about the potential for loss. It's also about the potential for gain. A well-managed portfolio balances risk and reward, adjusting as you age and your financial goals evolve. Over-conservative investing can lead to significantly lower returns over time. For example, if you invested $100,000 in a low-risk, low-return investment yielding 2% annually, after 20 years, you'd have around $148,000, $149,000. However, if you had invested in a diversified and balanced portfolio with an average 7% return, you'd end up with around $387,000, over 2.5 times as much. By the way, the average inflation over the past 20 years has been 2.6%. This means if you were the investor in that first scenario, your purchasing power would have lost value in real terms. Many investors make poor portfolio management decisions based on fear or greed rather than a well thought out strategy. It's crucial to maintain a long-term perspective and avoid reactionary changes based on short-term market fluctuations. So how can you start boosting your retirement savings today? Here are some actionable steps to improve your portfolio. First, reevaluate your risk tolerance. Assess your comfort with risk and consider diversifying your portfolio. If you're younger or still a ways from retirement, this might mean increasing your exposure to stocks or investing in index funds that offer broad market exposure. Second, make your money work for you by adopting a strategy of regular portfolio rebalancing to maintain your desired risk level. Lastly, seek professional advice by consulting with a financial advisor who can help you develop a personalized investment strategy aligned with your goals and risk tolerance. By following these steps, you can take significant strides towards boosting your retirement savings and securing your financial future. Another reason I see that people aren't retiring before their friends is that they haven't accounted for or are miscalculating all the benefits they will receive in retirement. This includes Social Security benefits. Many people neglect to actually look at their benefits until they are about to retire, and they aren't including that in the total amount of income they're going to utilize in retirement. What this means is that they are over-relying on their portfolio to do the heavy lifting in retirement when in fact they haven't fully included their Social Security benefits or pension funds that they may have access to. The easiest solution to figure out your benefits is just go straight to the Social Security website. You can put your information and it will automatically pull your entire work history and give you an estimate of your benefits. It will show you your benefits if you take your Social Security early, or what your expected income is if you delay it to full retirement age or beyond. It's that easy. Once you know this number, you can alleviate some of the pressure on your portfolio withdrawals. The final point we'll discuss today is the importance of flexibility in making lifestyle changes to reflect a new reality in retirement. Many people have lived in the same location close to work for decades, often in a large house that suited their family while raising children. However, as their children grow up and move out, they remain in this large house, which now represents a significant amount of untapped equity. Recognizing this is crucial for two reasons. First, downsizing your home to access your equity can be a major financial benefit. You can often eliminate your mortgage entirely if you still have one, providing immediate relief in monthly expenses and freeing up thousands of dollars. Second, a smaller home typically means lower utility bills, reducing costs during hot summer months like it is right now, or cold winters. It also may help with taxes on your home as well. I'm going to end our video today by reminding you that you might not actually be behind. You may just need to reassess where your portfolio is and some of the calculations you are making behind the scenes. Now you know the strategies some wealthy individuals use to build even more wealth and retire early. You can use everything that we have spoken about today in this video to improve your financial situation. However, as always, whether it be tax or investing, there are risks we haven't been able to discuss today. If you want further information on how best to maximize your own wealth without the worry of something going wrong, or would like a partner in understanding how that works, click the link below to book a free consultation where we can discuss what strategies work best for you.